Hello everybody, I'm your boss, Joe Boss, and welcome to another week ahead trade plan. We got quite a week ahead of us. I have an expectation that dollar's probably gonna drift a bit weaker into next week. Their tab here real quick and find it. Ah, there it is. Here is the calendar for the FOMC blackout period. And if I zoom in here on the right, we are here, April 20th. Happy 420, everybody. And also happy Bitcoin halving. I know it was yesterday. But yeah, happy Bitcoin halving. The miners are freaking out a little bit. The very first block on the Bitcoin chain when the halving occurred had a fee of like 3 Bitcoin on it. The fees are a bit elevated right now. Getting your transaction through the mempool is a bit hectic at the moment. Anyways, let's see who we got watching today. All right, pretty clear chat, so I'm all good to go on my rant here. So, right off the bat, going into next week, we're not going to be getting any commentary out of the Fed, except for if they're going to do some sort of press test or press leak, which happens all too frequently with the Fed and the Bank of Japan and every central bank. There's some leak or press test in case markets start moving in a direction that the central banks don't like, or, insider trading shenanigans. So with this FOMC blackout period that we have coming up, I'll go ahead and bring up the DXY. And zoom in here a little bit. My expectation for the dollar is for this to essentially close sideways at the moment between R1.5 and R2.5, or to come down like this. See, I had more bullish expectations here at the start of last week, or rather, I think at the start of the week we just finished. I had much more bullish expectations. But going into the end of this week, we just didn't get that data to fall through. And now, looking at the following week, I'm more or less setting my expectations to be more along these lines here. Essentially sideways, essentially holding up, trading around 106. And I'll set that to red. And set that as my net expectation. Let's look at the 12-hour chart. Actually, on the DXY, it's more optimal. Just turn off the auto time frame, set the pivot time frame manually to 1 week, and then go to a daily. This way we get more data loaded into these pivots. Yeah. It's a little hard to see because all these boxes are pretty flat, but I'm going to highlight here for you guys. Right here, that 11, 11, 13. So it's like this area here is the play zone, which is effectively range bound between R1 and S1 next week. Range bound on a closing basis. And we can go ahead and check our high odds real quick. I'm pretty sure they're a bit more consolidated up here around, yep, you can see right there's our probability weighted pivot. So if there is an up move, it's probably going to be equivalent to the high of the last week. So it'd be something like that. But I'd expect more of a down move at the beginning, and I will tell you why. So if we check out the economic calendar right over here. And we check out Monday. So the first trading day of next week, we have Canadian PPI, ECB. We got a lot of ECB speeches next week, guys. So, for example, euro dollar. This thing's probably going to recover a bit. And if you look at the yield spreads short term are improving, and even a little bit on the more intermediate term here. And I know some people, they look at this indicator and they're like, Joe, where does this data come from? Just look at the yields for all of the bond durations and take the difference between the euro bond yields and the US bond yields. And when you take those differences over different time horizons, you come up with a sort of moving average interpretation of, hey, here's the difference of all of those yields from today to yesterday, today to 7 days ago, and today to 25 days ago. And you can see net from 25 days ago, we are down, and the yield spreads have been very negative. And most of the negative movement we see, most of the negative cumulative movement of this yield spread has come from the last 25 days. So that's quite strong bearish trend. But just because you have net cumulative bearish yield spreads over the last 25 trading days doesn't necessarily mean that you can't have pullbacks. Like in this example right here. And man, that was a good trade and good expectations, and it wildly overshot my expectations. It doubled it. All fine, all good so far. However, I look at these yield spreads, and now that we're at the close here, for example, on euro dollar, and actually on a lot of dollar pairs, I see the yield spreads getting slightly stronger here at the end of the week. And now I'm like, well, when you real quick and you see what's coming up next, look, you have PMI. We have all these flash PMIs on Monday for Japan and Australia. And then you have all these flash PMIs for Europe on Tuesday, the following trading day, for Great Britain, for the United States. And if I zoom out just a bit, you can see the forecast and consensus numbers. So consensus and forecast is for all these numbers to come out higher. And there's no reason to expect these numbers to beat, to miss their beat, especially on the manufacturing side. In fact, on the manufacturing side specifically, there's quite a lot of momentum that the manufacturing PMIs will continue to improve. So with that, and services remaining relatively flat, maybe they go up a little bit, maybe they go sideways, maybe go down a little bit. So long as there's no surprise on the services side of things and manufacturing continues to recover, this, frankly, from Monday, Tuesday, and then you have inflation coming out for Australia, there's a huge improvement for the year over year expected. A moderate improvement, more sideways-ish for quarter over quarter. Monthly is also expected to either stay flat or slightly improve. This is actually quite important for Australia. However, lower inflation does mean that, hey, Australia might need to cut rates sooner than expected. We'll see when we get some RBA speeches out. And then here you have Bundesbank speech, and then I think there's a couple more Bundesbank speeches. And then you have sentiment index out of Germany. And then there was another, then you have IFO here. You have, and then look, ECB speech, ECB speech, ECB speech. So there's a lot going on with the ECB. And Germany specifically, sentiment data coming out that is expected to improve over the first 3 to 4 trading days of the week. So I would, on this euro-dollar, expect the short-term yield spreads to improve going into the week. And if you look at these odds here, these are the low odds. So these are your probabilities over the last 21 years that we've had our low between any two pivots next week during the 17th week of the year. And if you look at this, above this central pivot, that's at 28.57%, which when I look at this, I say, hey, that's a pretty big continuation odd risk. So I'm going to go ahead and bring up the high odds here, probably flip this to green, maybe do something more along like this. And yeah, you can see there's kind of 3 spots to check out here. Right here, here, and here. And I'm going to undo that because I don't like that red color. Right here. And I'm going to switch that up to yellow. Yeah, there we go. So these 3 spots are what I'm looking at for finding a high. And then you have your probability weighted pivot, which is condensing all of this information, all these odds, weighting them against each pivot point and giving you a single value. This is kind of like the mean of this entire histogram of probabilities. So this is looking pretty good for some more upside, probably breaking the high of next week. But then once we get into Thursday, Friday, I'm actually going to expect a pullback into the close. So maybe we pull up above 107 and pull back down to 107. I'll go ahead and actually lock that in as my expectation for next week on euro dollar. Now, why would I expect this pullback? And this is generally going to be the theme for all the US dollar pairs that I'm looking at, and some of the JPY pairs, specifically because once we get to Thursday, you have a bunch of US data coming out. So you have advanced GDP. So this is like the preliminary or flash PMI data. So this is like an early look at GDP. That's expected to come down. And then you have jobless claims also coming out. Then later on the same day, you have Japanese inflation, Australian PPI, and then the big kahuna way later on in the day for me, which is the BOJ interest rate decision and the quarterly outlook report. There's a lot of in-depth outlooks covering these two events. Not much is expected to change. However, everyone's going to have their eyes here on the quarterly outlook report for the first set of forecasts from the BOJ that go out to 2024 and any revisions to their inflation outlook for 2024 and 2025. I think I might have misspoke there. We're going to have the first set of inflation and just economic forecast numbers out of the BOJ for 2026. So this is going to be quite important going into the end. And then you have a few more ECB speeches, a few more, some Spain data, and then you have more US data. So once you get into Thursday and Friday, you're starting to get into more US data. And this US data can come in strong. So initially, the US data here into the beginning of the week is quite light. And you get more heavy-handed look at the rest of the G7's economic performance. And so temporarily for the beginning of the week, you could actually see the rest of the G7 starting to improve macroeconomically, give a bit of reprieve, setting this upwards expectation. And then towards the latter half of the week, as you get the bigger chunks of US macro data and this Japanese outlook here, and then going through more US data, more consumer expectations, more inflation data coming out, PCE. And PCE is expected to just come in nominal and flat. It'd be pretty bad if this came in a bit higher. And then that's it for the week. And hopefully that makes sense as to why I'm setting this type of expectation into a lot of assets. It's going to be a little different if you're trading equities, because equities have just been hit so hard this week. I mean, how in the last 24 years, how many times have we, in the last 24 years on the NQ futures, we've never gone this low before here during the 16th trading week of the year. And next week, you have very expanded pivots. And you can see we have that big fat 33%er right there. Oh man, there's not a whole lot of bullish expectations for a lot of the earnings next week. Essentially, the uncertainty is very high for a lot of equities, for a lot of earnings. SMCI. Oh my god, yeah, this is terrible. I'm seeing forecasts of 600, and I understand one of the reasons why we dropped here is because usually SMCI likes to pre-announce some of their performance for earnings around this time, and they remained quiet. So a lot of people were buying puts into this, and then when they failed to do any sort of pre-announcement, it just dropped 23%. Oh my god. Yeah, a lot of people were watching SMCI here on Twitter, so this one's caught my eye recently. A lot of smart guys were putting on puts here, man. They made so much money. And they're still going for like 600. Insane. Okay, so what else do we have going on? Because that's kind of the main thing to look out for the week ahead. Is kind of the change in this macro data from the beginning of the week into Thursday, Friday, and how things can switch very, very easily. One thing I'd say is don't lose your head, because there's going to be a lot of commentary around, oh man, the dollar, this dollar bullish trend is now over. Oh my god, we really need to consider like the dollar going to 104 potentially, like as people talk about the pullbacks over the relative improvement of the rest of the G7 over the US as we get good economic data, hopefully out of the rest of the G7. And they have this tunnel vision where they're just looking at data that they're getting right then and right there on the day without looking at, what's going on for the rest of the week. And all the US data that's coming in towards the end of the week that can also be really, really good, because the US is having its own economic recovery. So some people are going to get short-sighted, and that sucks, but people are going to do what they're going to do when they don't set good expectations, or at least have some form of nominal expectation that as they get new information that goes against their expectation or exceeds their expectation, that they can then update their belief and adjust their approach accordingly. Yeah, man. It's pretty nutty once you start having some foresight on expectations, and that's why reading outlooks, I think, is incredibly important. Speaking of, I finished my outlook notes here, and you can see we cover a lot of different outlooks from a lot of different institutions. I remember I posted a video, an actual video, not a stream, not too long ago. And check this out. Research global manufacturing recovery to continue into the summer. This is the only outlook that I was able to find that espoused the same idea that I had going into the summer of this year. Like, hey, when we get this increase in manufacturing PMIs and this momentum continues, potentially going into the end of Q2, beginning of Q3, this is going to make either goods inflation sticky, if not rising more positively. As services inflation stays flat, it's not good. It's going to lead to a net positive increase in inflation globally and in a lot of developed countries. So that was nice to see an institution espouse the same idea. And yeah, I would say just not many people are looking at that. A lot of the outlooks that I read for the week ahead are mostly talking about stuff like way out here into the future. They're talking like late July, August, Q3 stuff. And yeah, you could see 108. Yeah. Real quick, I am actually interested in the weekly ranges here. So I'm going to turn off the auto time frame. Check out the weekly ranges here for next week. And let's go to euro dollar here. We can go to a 12-hour on this one, I think. Yeah. Yeah, and you can even see here on a 12-hour, the yield spreads are starting to improve on the short term more positively. So I would say the low comes in around here or right off the bat. And then we run up here to about 1072. And then we can also check out Aussie dollar. I don't think Aussie has as good of a call, specifically because we have inflation data for Australia coming out here on Tuesday, and then it kind of peters out as far as economic data is concerned. And if the inflation rate continues to fall, the expectation for, okay, the RBA is going to do some more rate cutting. Yeah, like the expectations for the RBNZ and the RBA doing their rate cuts is getting pulled ahead. Well, one other way to put it is that the Fed is expected to stay higher for longer, and the RBA and RBNZ are expected to cut before the Fed now at this point, or to do more cuts cumulatively this year than the Fed. And that doesn't set a good long-term outlook. It definitely puts a negative drift on prices. So even if there is a week or two of really, really good data that comes out, it has to move in such a meaningful fashion to potentially reverse those expectations of, oh, they'll go ahead and cut sooner than the Fed, or vice versa. Something changes in the US data that says, oh, the Fed's going to be cutting rates at a similar pace to the RBA or the RBNZ. And that would also make this go up because that would bring US yields lower. But in the meantime, I'm still on the more bearish side. Because, I mean, compared to the euro side of things, like we had such high probabilities above the central pivot, we had such high probabilities clustered just above S1. And now when you look at these odds, you can see they're very spread out around this S0.5, S2.5 area for where to find the low on the week. It's essentially a guess. You can use the ranges and say, well, most of the time we got our low here, and then in really bad scenarios, we get our low down here. I'd say next week can probably be a crapshoot. Nominally, I'd expect something along these lines, a little bit of up and a little bit of down into a close. Let's see here. Did I turn off the next period? Yeah, I did turn off the next period there. Yeah, something along here. I'm expecting essentially a flat week on the Aussie going into next week. And sure, maybe it goes a little higher. Maybe it goes a little sideways. If we go ahead and look at our high seasonal odds with the probabilities, the pivot probabilities here, yeah, you can see it's like close to 60% of our odds are below this R1. So I would be expecting something along these lines here. We can also use the ranges to help set up some risk tolerance there, stops in the troughs, entries at the peaks. So maybe something along here, 64.75. Yeah, that looks fair. And then set this to, oh, real quick. Set that to green, because that's the bullish expectation. So I'm not expecting too much. But understand, because we're now in this Fed blackout period for all of next week, at any point in time, something from the Fed can get leaked. Something from the Fed can come out saying, oh man, they're getting more hawkish. You get that one Bloomberg article saying, oh man, the Fed's getting more hawkish. We have an insider at the Fed saying they're getting more hawkish. You get the rumor mill out and about, and that'll send you to like below 104 here on the Aussie, and it'll totally ruin any upside potential, any upside recovery that you could get next week. And then also another reason to expect some sort of pullback into the end of next week is that most people who are going to begin trading next week, they may not expect this strength, and then they may not expect this move lower, because they're not thinking about not just this upcoming week, but the following week over here. Because look at this calendar. The 30th of April and the 1st of May are the FOMC meetings. So right around here, actually I can just use this hotkey. Those are the two dates right here for FOMC. And FOMC is expected to still stay tight and higher for longer. Because don't get me wrong, they could get some economic data that shows everything is going fine and well and the economy is growing. But inflation, PCE is not going to move the needle on inflation enough to taper the market's expectations of future inflation. That PCE is just not going to do that. And then if the jobs market continues to recover, when we go ahead and look at this stuff here going into the end of the week on Friday, all of these economic metrics, if these things come out good or they are on a trending path to getting more bullish, it could induce, hey, good, getting to Thursday, front running these events that might turn out really good. Well, if they turn out fine and they don't change the Fed, our expectation of what the Fed's going to do in any significant way, this last day is probably going to be dollar bullish. And then that dollar bullishness can just run into FOMC and then get stronger as FOMC confirms essentially that they're not going to change their pace and they're going to stay higher for longer, and they need more inflation data over the summer to come out in favor of everything returning to a more nominal policy before they can definitively say when they could cut rates or not. So don't think in my opinion, the best way to think about this week is contingent not just on how the data immediately prints, how it actually prints next week, but how it updates our expectations for what could happen during FOMC and all the economic meetings we have going on throughout May. Again, I'm also going to stress, hey, it's the Fed blackout period, and I am going to be very, very, very cautious on any longs that I take, because I am all too familiar with the probability of those press tests, of those rumors, of those leaks coming out and saying, oh, the Fed's super hawkish, oh, the Fed's super dovish. I mean, in that scenario, it might be an even better shorting opportunity going into Thursday, Friday, as the data comes out strong for the US economy and the Fed says, well, this data is good, but we're not totally there yet. We're not totally committed to moving there. They'll say something along the lines of, oh, if we get more data similar to what we just got over May and June, then maybe in the June meeting we can reconsider whether or not we will start cutting rates in July or September or whatever. But outside of that, there's not too much extra weight. The trend that's been set over the last month or so now, especially after the last US CPI and rebound in manufacturing data, and now all these geopolitical risks about oil and oil supply being under threat from all these, geopolitical conflicts. That's also another risk. I mean, one of the reasons why manufacturing PMIs are going up, up, and up, and global manufacturing PMIs going up, up, and up is because manufacturers are more willing to pass on price increases and are willing to pay these higher prices for the energy and commodities they need to produce the goods that they produce. And then they'll, even though they're producing them at a higher price, they will go on and pass on the higher costs that they had to their consumers. And then there's your goods inflation. And if that momentum continues going into the summer, well, now you're going to have sticky global higher goods inflation. And I'm just reiterating that because now I'm pretty dead set on that expectation. And with that in mind, inflation being stickier, Bank of America, they just said, hey, if the Fed potentially hikes one more time, we're probably going to go to parity on euro dollar here. Oh, man. They actually said, hey, we do one or two more hikes, and this thing is going down like 650 pips, like over the next few months, potentially. I mean, everyone in every outlook that I read, everyone's updating their expectations to get more dollar bullish. So, don't get me wrong, short-term trading, even on the week-by-week basis, that can get frustrating if you have a spike in your volatility and it stops you out and then it runs in the direction that you traded. Don't let that stuff try and get to you too hard. It is far more important to stay consistent and clear-minded and to set good, proper future expectations for the assets that you're trading than and then go ahead and use tools like this to say, okay, well, where's price likely to go under those expectations? It doesn't have to be these tools. There's hundreds of tools to do that with. But whenever it comes down to discretionary stuff, start with your expectations. Actually, better yet, start with what the market's expectations currently are and then find out what are the key catalyst events that can change those expectations, so you can keep an eye out for what could update the market's expectations going forward. And then as soon as that new information comes out, you can immediately and as quickly as possible update your positions and your own expectations. Maybe cut losses or reverse your position or double down on a position. It depends on how the expectations changed and how you were already positioned. Again, discretionary trading is not the easiest thing in the world, especially when major events happen overnight and just totally shift the market going the other way. And you have to be willing to not take those hits personally, because information comes out fast and you're not going to be awake all hours of the day. So this is where having contingencies really is helpful, and thinking of the entire distribution of ways expectations can change and putting yourself in the best possible position that, okay, if expectations change a little bit this way or a little bit that way, I know I'm going to be okay. And figure out the series of scenarios that could occur that would change the market so drastically that you're okay not being in it. And that's all well and good. I mean, for example, on euro dollar, I was expecting this thing just to keep going up and up and up into the end of the week. Things started to improve for a lot of these assets. Yield spreads started to improve in the last 48 hours of the trading week. So, for example, on USD CAD, I had this long here and it was doing great. And then the expectations went against me. I was expecting us to go much higher here. You can see my drawing. And I got a great entry with a really small position size. I was going to get like 10R potentially on this. And then we pulled back all the way here back to my entry. And I'm like, okay, something is changing. The data isn't coming in right for this run to happen right now. And then on this bar, the thing just tapped my stop on the spread. And that sucks, right? That sucks. But this already was a small size, and that's why I was able to set such a tight stop on that. If I have a larger size, I'm going to have... Actually, it's kind of vice versa. I already had a small size here, so having my stop way out here would have made it even smaller. So I just squeezed this small position for whatever I could get it for. And it worked for about 48 hours. And then the next 48 hours, it went away. So over 4 days, essentially, I had a tiny loss. And while it sucks to see all that money come in and then watch it go away, it's not the end of the world. So long I'm setting good expectations, I can do this sort of thing day in and day out. I mean, I had another trade way down here. And then on euro dollar, I had this trade here. I mean, just from this trade alone, even though it was suboptimal exit because these yield spreads were just so freaking negative, I should have just held on to it because of these negative yield spreads. This is a lesson I still gotta learn. Just listen to the damn yield spreads. But that little loss is like a fraction of this thing here. So that I'm still doing okay. I'm still doing fine. And that's what matters, is having that type of consistency and having good expectations line up over many weeks, over many months, and that's how you get the compounding. And a lot of people try to automate this stuff. It takes a lot of work, and you got to be very smart to do it. So, you know, there's a little extra rant that I hope you found was particularly insightful. And for everyone who's interested in this breakdown, these are just notes of outlooks that I've read that are freely available. And by the way, this little bullet point section here is essentially like the one-page executive summary here. And Eagle Eye also is a free outlook available here on from Barclays that you can find. All of these are all publicly available. None of these outlooks are like behind a paywall or whatever. But yeah, you can see right there, concern about global goods inflation will rise into the summer as manufacturing indices recovering mostly from increasing costs and passing on higher prices is still a concern. And then Eurozone flash PMIs next week are the highlight for the EU. They're expected to come in better than prior with focus on inflation-based sub-indices. Lots of ECB speeches to follow next week. So I've kind of hit on all of these points, including, hey, US dollar higher. I mean, the only thing I haven't covered here really is crude, which has tumbled quite a bit here. Especially, like, this has been insane. Following oil supply dynamics is not the easiest thing in the world, especially if you're discretionary. There's a lot of big players in this market. I still expect oil to go above 90 at some point here, especially as the manufacturing PMIs continue to rise. And net, excuse me. Thank you. Net, if all these geopolitical conflicts don't escalate, let's say that's like the base case scenario, they kind of stay at the same level of conflict that they're currently at over like the next 2 months, that's still extra pressure on oil supply. That's still extra uncertainty, extra volatility, extra variance that can come into the oil price. And that extra risk, even if all these conflicts stay the same in Ukraine and all the stuff with Israel going on, and now there's stuff going on with the Red Sea and Strait of Hormuz, and there's now stuff going on with Venezuela. Venezuela had some licenses revoked, I think today or yesterday, about people being able to buy Venezuelan oil. They're like taking away some of their licenses to do some oil transactions. There are extra risks of oil going higher. And even if those risks do not escalate kinetically, they are still present and are still going to put a positive drift, I believe, on oil over the next few months. So even on a situation like this, I'm still like, well, okay, is the coast clear? Can I watch the street and look both ways before crossing it to make sure, like, okay, is now a good time to get oil exposure? Is now a good time to get oil exposure? Because this certainly was not. You can see my expectation was for the thing to have a little bit of a bounce. Boom, you have a geopolitical issue come in, and yeah, you're now way down here, and you have this like, look at that thing. That is, it's like a $5 top wick on that thing. That's insane. And this is WTI crude, not Brent. Yeah, and then you can see BOJ here, and then there's a bunch of Bank of England stuff coming out. Bank of England expected to hike. I'll go ahead and pull up the Great British Pound as we do that. Yeah, that's not looking too great. Yield spreads are slightly improving on the more intermediate term, but short term, long term, not so much. Let's go ahead and check this out. Yeah, it's not looking too pretty. Not looking too pretty, boys. This is giving me some hope. maybe something along these lines, like a down a little bit. Let's look at our closing odds, to be frank. Where are most of the closes next week? Okay, so somewhere here between R1.5 and S1. And there seems to be more of a bias towards closing around here at R1. But the UK economy is just not doing so hot. It's just not. Let's see here. Bank of England is expected to hike rates ahead of the Fed and ECB. Now, this is like Q3, Q4 we're talking about with this expectation. The UK is not expected to economically recover as quick as the Eurozone, which is making some people look at Great British Pound. Euro, Great British Pound. Yeah. You can see the yield spreads are starting to flip here. They were super negative here yesterday, and then today, or rather in the last trading day of last week, it's improved significantly. And based on the expectations that I'm looking at here for next week, I would be totally fine expecting something along these lines, essentially another 50 or so pips higher. And again, it's totally okay to be wrong on an expectation. The whole point is have an expectation and then learn from it when you're wrong, learn from it when you're right, and learn from it when you beat. So then over time, you learn what expectations were good, what expectations were bad, and why those expectations were of the quality they were. And then over time, you kind of build up this repertoire of actual knowledge and experience because you've actually compared what you expected to happen and then post fact looked at what actually happened. Okay, DXY. I think everything is all set and all good now for the week ahead. You can see all of these companies, Alphabet, Microsoft, Meta, Verizon, all these companies are giving earnings. One of the busiest weeks in earnings. Oh, man. Again, if these companies come out mixed, it's not going to be good for equities. It's not going to look so good. It's probably going to drive bonds higher if that's the case. But you know what? The S&P has been falling quite a lot recently. You can clearly see that we're now at 5,000. But then when you check out the US 10-year, it's effectively flat around here, following it a little bit. And the yields just keep rising and rising. The risk is that we go to 108 again on the 10-year yield, which would not be great. That would probably be like 4,800 on the ES. It's not looking so hot here on the S&P. Let's look at our probability pivots. Yeah, check that out. Most of our odds here next week are for some recovery or for a close here around the 48 handle. Real quick, I actually want to check out the monthly levels. Wow. In the last 26 years, you only close around here 3.85% of the time. So a lot of bounce could occur here going into the end of the month. And real quick, let's look at, yeah, and then you can see a lot of closing odds for the month are around here as well. Go ahead and look at some monthly lows real quick. Yeah. Oh, hold on, that's incorrect. These are supposed to be up here. Sometimes this needs a little bit of extra time to load. Sometimes it needs a tick update to put it up here. Let's go ahead and bring up the probability pivots real quick and look at the low odds here. And yeah, in the last 26 years for the month of April on the S&P mini futures, we've never gone below this S2.5 pivot. So I don't know, maybe around Wednesday, Thursday, we find a bounce that takes us back to like 5,100. I would be hopeful for the S&P going into the end of the month. Okay, with all that said and done, that's going to be the week ahead trading outlook. And if you guys want to hang out, do some trade research with me, check out the Discord, click on the WAP link in the description and join the Discord. That's free. And if you want access to all these indicators, you can actually get them for free. Just start the trial for them, and you'll also get access to the trading group. All right, you guys. I will see you all in a bit.